A warning from France's finance minister. The Eurozone's second biggest economy faces the risk of a financial crisis after snap elections were called by President Emmanuel Macron. This week, the country's three biggest banks have lost between 10 to 15% in value. The risk premium on French government bonds also surged. So what happens next? Let's take a closer look right now on Market Insight. I'm your host Ramzan Karmali, and joining us on today's show is CEBR's Chief Economic Advisor, Vicky Pryce. Vicky, thanks so much for being here with us. So the French economy looks like it's downward spiralling at the moment. Snap elections begin in just 2 weeks or so. Is there enough time for things to go from bad to worse?
I think it all depends on what happens at the elections themselves. The snap election has worried the markets anyway. What we did see was immediately a reduction in the value of the euro. You saw stock markets across Europe falling. What you've seen since is that this uncertainty and insecurity about what the outcomes might be continue. And it has affected lots of other markets too. It's become much wider because, of course, France is such an important economy. And with Germany itself, we just got some latest data about the Eurozone industrial production just a little while ago. What we've seen is that there was a drop 3% year on year in industrial production in the Eurozone, and that, of course, is a worry. If France goes downhill, if you like, certainly after the elections, there are worries about whatever the RN is proposing to do in terms of what it might do to the deficit, what it might do to its debt. Then we can see Europe perhaps slowing down again just after it was beginning to rebound.
But even if the National Assembly does swing Macron's way when the results come out, will it be enough to turn the economy around, or has the damage already been done? What happens if the far right does take control? Do you believe that that debt will just get out of control?
Well, the debt is a problem, but more importantly, in the very short term, is the deficit. France has a very high deficit right now, and it is also in danger of coming under the excessive deficit procedures. So the EU looks at that. But of course, very often there are fines imposed which are never, in fact, properly executed. But certainly if Macron's party does well, then things will calm down. There is a prospect now, of course, of the left all getting together and having a coalition of sorts and fighting the election that way. And if that is the case and they do reasonably well, that adds an extra dimension of uncertainty to the whole picture. So, the economy has not been doing that badly by comparison to what it used to do before. In fact, it was expected to grow by about 1% this year. But this is certainly putting a bit of a brake.
Now, next week we hear from the Bank of England, but before that we have inflation data as well. What are you expecting on the inflation front, and could that impact on what the bank does the following day?
Well, May had always been anticipated with great interest from everyone because that was the month when in the UK we're meant to see inflation at or even below target. So the expectation in the market now is that it could be 2.1%, it could be even lower. And that will be actually a very important factor in whatever decision is made. The only problem is that we're having a snap election ourselves, of course, and we have to wait until July the 4th to know what's going to happen. But it will be very dangerous politically for the Bank of England to reduce rates now because it will be considered as a gift maybe to the incumbents. But who knows what they will decide to do. The expectation now is that they may wait and not do anything until August when they meet next, which will be a shame because the economy is crying out for lower interest rates. We've seen what's happening in the housing market. We've seen prices, in fact, either stabilizing now rather than the increase we have seen, or even falling in some areas. And we've seen mortgage rates actually go up again in recent weeks. So that's not good for anyone who is hoping to escape the very high rents they're paying and buy a house. So it's going to be a tough time. So we may have to wait because of the snap election, I'm afraid, despite the likelihood of having very good data on the inflation front coming out next week.
Do you expect any more for 2024 after that from the Bank of England?
Yes, I think we have to see more than one cut. And there is a real danger that if interest rates stay where they are, a lot of the improvement in consumer confidence and business confidence we have seen recently is just going to evaporate. Everyone is counting on those cuts, and they're counting not just one 25 percentage point cut, but a lot more. And I think it should come. There is no real reason why interest rates should be so high when inflation is so low.
Now, this week we heard from the Federal Reserve as well. Inflation obviously weighing heavily on the minds of policymakers there too. They held steady for now, and economists say they anticipate just maybe one cut. Some are even talking about two. Where do you stand?
Yes, I mean, we've seen what's been said, and they are talking really, if you look at the way in which the various members of the FOMC have voted and what they think was going to happen to interest rates, that indeed we're only going to see one cut. I think that's very unlikely to be the case. I think there'll be more. The interesting thing for me is the data that's come out more recently, which shows, first of all, that the personal consumption index, or the personal consumer index, which the Federal Reserve looks at very carefully, is coming down. I think that's good news. That's the one that excludes energy and food prices. And it is very, very close to target, just over 2%. And what we've also seen is that wholesale prices have actually moved into negative territory. So the latest data shows that year on year, those prices have fallen. And I think that's a very important factor. And if that is the case, then I don't really see any reason why rates should stay as high as they are in the US either, although, of course, they do have a slightly more buoyant economy than either the EU or the UK.
Vicky Pryce from the CEBR, many thanks for your time. And that's Market Insight. To learn more about these stories as they develop, head to Reuters.com.